With the Fed continuing to raise interest rates in an effort to tame runaway inflation, investors have become spooked. During these phases, newer, growth-oriented companies tend to suffer as much of that growth is fueled by the company taking loans to obtain the necessary capital funds to fuel that growth. But with rising interest rates, that makes these loans prohibitively expensive. In turn, investors typically flee to the safety of more established and recession-resistant stocks, such as utility companies. These companies typically have relatively low growth rates, but tend to offer above-average dividends. But the two utility stocks I'll be talking about today combine the best of both worlds: growth potential and the stability that utilities are known for. And if you don't think that you can have insane growth and stability at the same time, then I'll simply let the company's track record speak for itself. Since 1995, this company has significantly outperformed the broad S&P 500. A single $10,000 investment in 1995 into the S&P 500 would have yielded you around $112,000 with dividends reinvested. That's a pretty solid return that any investor would be happy with. However, during that same time frame, you would have generated 4 times the results and had a whopping $432,000 had you invested in this utility stock instead. Those are the kind of results that investors dream of. So what stock am I talking about? Well, it's none other than NextEra Energy, stock ticker NEE. NextEra Energy provides all of the advantage of a defensive utility plus exposure to a fast-growing and highly sought-after alternative energy market. It's the world's largest utility. It's a monster with about $20 billion in annual revenue and $152 billion market cap. Ordinarily, when you think of a huge utility, you probably think it has lackluster growth and a stable dividend. But that's not necessarily true in this case. Earnings growth and stock returns have well exceeded what is normally expected of a utility. NEE has consistently outperformed the market, and in recent years, NEE stock has returned more than double that of the S&P 500 over the last 10 years, yielding 480% with dividends reinvested. But how can that be? Well, it's because it's not a regular utility. NEE is actually 2 companies in one. It owns Florida Power and Light Company, accounting for about 55% of its overall revenue, but it also owns NextEra Energy Resources, the world's largest generator of renewable energy from wind and solar, and a world leader in battery storage. It accounts for about 45% of total earnings and provides a higher level of growth compared to its peers. Investors love it because they get the safety and income of a utility and still get great growth and capital appreciation, sort of the best of both worlds. There's also a huge runway for future growth projects. NextEra has deployed over $50 billion in the last few years on growth and expansions and acquisitions. Since 2006, NextEra grew earnings by an average annual rate of 8.4% and grew the dividend at an average rate of 9.8% per year. That propelled the market returns stated above. The company is targeting a 10% earnings growth over the next 3 years and 10% annual dividend growth through at least 24. NextEra has a long track record of meeting or exceeding goals. With a current dividend payout over 2% and significant growth potential, NEE is a stock that could easily fit into any investor's portfolio. Up next is XEL Energy, stock ticker XEL. With a dividend payout of 2.85%, XEL Energy provides all of the defensive and recession-resistant advantages of most utilities, plus exposure to the fast-growing and highly sought-after alternative energy market. It has the reliability of a utility plus much more growth than average from its sizable clean energy business. XEL is a regulated electric and natural gas utility serving 3.7 million electric customers and 2.1 million natural gas customers in 8 states, primarily located in the northern and southwestern U.S. It is also one of the largest renewable energy providers in the U.S., with about 30% of its electricity sales generated from alternative energy sources. This alternative energy is what separates XEL from the utility pack and makes it a much better investment overall. It enables investors to play defense and offense at the same time. You get stable earnings and low volatility, along with exposure to one of the most exciting and fast-growing areas of the market. Results support the fact that XEL is an excellent utility stock. It produced average annual returns of about 12% for the last 10 years. That's far better than its peer group over the same time. SimplyWallStreet.com estimates this stock is 65% undervalued based on discounted cash flow models, implying that this could be a solid long-term choice not only for its dividend payouts, but also its growth potential. So that's going to wrap it up for us today, guys. 2 solid utility dividend stocks that allow you to play both offense and defense at the same time. If you enjoyed this video, consider subscribing, and as always, I'll see you all again next time. Thanks.